Alastair Newton. He's co-founder and director, Avalon Business Advisory, joins us right now on the show. Needs no introduction, quite frankly. Alastair, good morning. At least good morning from us. Thank you so much for joining in. What are your thoughts here, Alastair? A binary event, two scenarios. Let's talk about the more probable one, Bremain and status quo. You think the markets continue business as usual?
I think the markets will certainly be reacting positively immediately. However, I would stress that unless the margin of victory for Remain is much bigger than polls are suggesting, this will not be the final word. Prime Minister David Cameron will have to cope with continued backbench rebellions, and we may well see what is known as a zombie government, rather similar to the one which beset the UK between the Maastricht Treaty in 1992 and the end of the Tory regime in 1997. That will not be good for governance and is likely to be at least a minor drag on market sentiment, but nothing like as big as the impact of a vote to leave would be.
Alastair, hi, good morning. And how probable is that? I mean, do you sense, looking at the initial polls, that a Brexit is a possibility at all, or do you think it's a complete no-no?
It's certainly not a complete no-no. This referendum, by general consensus, is too close to call. A lot will depend on the size of the turnout today. The general view is that anything above 60% is likely to mean a vote to remain. Anything below 50% is likely to mean a vote to leave. But that still leaves us with a big band of uncertainty, even if those percentages can be firmly relied on, which may or may not be the case. The problem is lack of historical precedence means that it's very, very difficult to judge this. Now, having said that, in the last few days, we've seen the bookmakers, who are generally more reliable than opinion polls are on ballots. We've seen the bookmakers odds swinging back towards Remain, and market pricing looks like it's putting no more than a 1/3 probability on a vote to leave right now. My personal view remains as it has all along, that this is going to be very close, but that in the words of the very distinguished British politician Peter Mandelson, the Eurosceptic but pragmatic British electorate will ultimately just about vote for Remain. Nevertheless, we could be in for a big downside shock by about this time tomorrow, when the result is expected to have become clear.
Do you think the downside risk also has been slightly overplayed? Because if there is an exit, the terms have to be negotiated. We don't know what the terms could be. And frankly, we tend to really look at one side of the story and then work on numbers. But ultimately, liquidity and other factors, they always play a role.
Well, I think the problem is that both sides in the campaign have indulged in assertion as if it were fact, and the campaign has been extremely fact-light. I wouldn't really trust any of the numbers which have come out for the economic downside of a vote to leave. On the other hand, it is worth keeping in mind that the majority of respected economists have come out very clearly and said that this would be damaging to the UK economy, not only in the short term, but in the longer term. And I certainly don't think we should ignore that. Now, you're absolutely right about the fact that we don't know what the terms of a divorce would be. But as you and your viewers know full well, there is nothing markets hate more than uncertainty. And we are going to be in for a protracted period of uncertainty, at least I would say 2.5 years, if the vote is indeed to leave.
Do you think somewhere, rather than looking at the social implications and the economic implications, do you think, it may sound unfortunate, but there is a lot of sympathy vote which would be involved in tomorrow's polling, and especially after that unfortunate incident of what happened to Ms. Fox?
I think the reality is that Joe Cox's sad murder may have an impact at the margin, in that for a period of 3 days we had no campaigning. Now, if we go back to this time last week, the Leave campaign had the momentum, and momentum really matters in elections, and they lost momentum as a result of the suspension of campaigning. I think that will have given the electorate some pause to think about issues. And on that basis, I think that there is more likely to be a swing back to what is the general pattern in referendums, whatever they're on, and that is that electorates generally opt for the status quo rather than a big step into the unknown. And given the economic uncertainties of a vote to leave, that's where I think the Joe Cox impact is likely to be.
You know, Alastair, we've been scratching our heads trying to, analyze what sort of impact would it have on emerging markets like India. Besides knee-jerk and besides, the company like a Tata Motors, which have businesses like JLR in the UK, do you sense that if a Brexit were to take place, this could be catastrophic and have a domino effect on world markets, and India too then would not be spared?
Let me split the answer to that into two parts. The first part is not what the economic impact on the UK is going to be, but what the economic impact on Europe as a whole is going to be, because clearly a vote to leave will be seen as a negative for the European Union. There is good reason to suppose that a UK exit vote does actually pose, in principle at least, an existential threat to the European Union. If the UK gets off on soft divorce terms, it will encourage nationalist and anti-European sentiment across Europe, and perhaps France, with its election coming up next year, and Marine Le Pen is going to be the most significant element in that. Negative sentiment about Europe, slowdown in growth in Europe, would clearly impact significantly on emerging markets. Now, the second part of your question is about India specifically. Yes, India is not invulnerable to this. It is part of the global economy. It is a key part of the global economy. It's a hugely important economy, as you know. But because it's not principally an export of manufacturing goods, I think it's probably less vulnerable than many other emerging markets. It's not big on commodity exports. It's not big on manufacturing exports. It's essentially a different sort of economy to, say, Indonesia or indeed China. And I think as far as India is concerned, although certainly there will be a sentiment-related shock and some substantive shock, really, I would continue to look at the economic fundamentals of India itself. And from an immediate market perspective, I think the more important question than what happens in the UK today is what happens in the next few weeks over the appointment of a new head of the RBI, which I gather from news headlines today is likely to be announced in mid-July. Markets will continue to follow that very closely indeed.
And since you do track India and India spokespersons as well very closely, Alastair, how have they read into the news that the current RBI chief, Raghuram Rajan, chose to step down?
Well, I think markets took that rather better than they might have done. It was a surprise to some market participants. It was certainly a disappointment to all market participants. As I said earlier, much depends on who his successor is. There's always a sort of risk around events like this that the wrong, in inverted commas, appointment at this stage could produce some sort of market impact similar to that which we saw with the initial replacement of Finance Minister Nene in South Africa at the end of last year. But so far, touch wood, markets have been calm. Let's see who Arun Jaitley announces as Dr. Rajan's successor.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.